right into it. Matt, our first question for you is, you know, you've seen a lot. What is the data telling you about the market dislocation, what we've been through recently, what we're currently going through, and what it looks like for a recovery, and where might markets be headed?
Right. So, we've obviously been through quite a bit. If you think about just 2020 itself has obviously been a difficult year and a very volatile year on a lot of levels, financial markets and or otherwise. We in our products do a lot of things at the single name level across the kinetic services. So, we have been able to look at this situation and create some parallels that we think are very, very interesting. And, we know our users are probably doing even more advanced ones. We looked back right after the pandemic, really in the spring, and one of the things we did is we did a case study on travel stocks that obviously have been very specifically impacted by the whole pandemic situation with COVID. And what we did was we actually looked at those in mid to late January through March 13th, when the World Health Organization declared the global pandemic. I think everyone was pretty much aware at that point. And we looked at how our data in some of those major travel stocks, so things like airlines, hotels, booking companies, cruise ships, and what our data was suggesting ahead of that time period. And we actually were able to parallel that against the 2008 financial crisis. We looked at a lot of the major banks, and what we did there was we started at the March Bear Stearns JP Morgan sort of brokered merger with the Fed, and we looked at that time period from then through September 15th, when Lehman Brothers declared bankruptcy, and we saw some very interesting parallels in the two groups. And that's just a little anecdotal study, but we think that our data does a very good job in these situations because our data is actually derived from real transactions. Obviously, we had the election last week, and we've had a pretty bull market since then. Market seems to be responding well to this idea of a divided government. Stocks tend to do well there, but certainly we're going to start looking through. How did the data look leading up to the election, and what did we see as things go forward?
Yeah, it's very interesting, and really, your data reflects what people are really putting their money behind their decision making. So you're actually seeing what people are actually doing, and also from different standpoints, from the institutional level, which are some of the smartest investors out there. So that must be very valuable when looking at past challenges. And I know your data goes all the way back to 2007. Our next question, getting back to all of those challenging environments, and one in which has brought us into this virtual world where everyone is working remotely. There's more of a shift towards digital. People are being more siloed and isolated, and they're no longer on the trading floor. Very curious as to what you're seeing in the data and how people are buying, and what is there a shift between what it used to be like and now people being isolated, being in their basement, being in their living room. What are you seeing as the impact on investing and active strategies at large as a result of this isolation and this new world that we've come into? We've had some time now. I wonder if you've done any analysis on that.
Well, what we've observed is interesting. If I had gone back to mid-March when everything locked down, and I had made a bet with myself as to what the interest in our data would be, I would have been pretty cautious and reserved because we knew we were entering a difficult economic period, and right away people start to question in corporations discretionary purchases like buying a data set. But what we've actually found is quite the opposite in this situation, and I think it has at least something to do with this whole new environment you're talking about, in that people in volatile markets, one, become very much more data dependent. They're more interested in testing new views of data. They're more interested in trying to answer the question of, okay, well, what is going to happen next? And the other thing I think because people are in these more isolated, siloed setups, and they have more time to do work, actually. A lot of people have been given back a lot of time each day because they're not commuting, and they seem to be working more hours. And as a result, in a lot of the people we've dealt with, they seem to have a lot more time on their hands to actually look at new data sets, test them out, put them through the rigors that they normally would put them through, to actually make use of them. So in some ways that has actually helped, because our users tend to be of the more academic type, and an academic responds pretty well to that environment where they're not sort of having the day-to-day office distractions that might come up.
Yeah, that makes sense. And maybe because they're not getting their data from the water cooler, they've got to get it from somewhere else. And you're certainly a fantastic source for that. How Our next question: how do investors look at, in looking at all this data that they're buying more of? How do investors look at post-trade data to find opportunities to generate alpha? Now, okay, so they're in this siloed environment. They're getting more data. How are they actually looking at it? And do you have any scenarios of how people are using it to generate alpha?
So maybe just before we get into the exact scenarios, let's just talk a little bit more about what is DTCC data, right? Because I think not everybody listening to this always necessarily knows right out of the box who we are and where some of this data actually comes from. But because there's been lots of products over the years that show things like volume and flow, and they're based on a lot of different sources. Some of them are advertised volumes or IOIs or bids and asks. So just so people understand what we're looking at here, right? DTCC is a market utility. We were created by most of the large Wall Street banks who still own us to this day, back in the early 70s. That was done mostly to improve operational efficiency, cut down on some costs, and spread out counterparty risk. As a result of that, and what that actually meant, right, is we clear and settle every stock and bond trade in the U.S. every single day. And then we have a couple of other businesses that have come up over the years more recently. One is involving OTC derivatives, where we are the global reporting facility for credit default swaps and interest rate swaps. We capture something like 98% of the notional, and that came out of a lot of the post-2008 legislation. And we also own the largest buy-side matching platform in the world, known as ITP, where a lot of buy-side parties match and allocate trades that they've executed with their sell-side brokers. Now, why did I waste everybody's time talking about all that? So the one thing that's common across all those different operations that we have within DTC or business, every single one of them is based on transactions that actually took place. We're not estimating anything here. We're not looking at something like indications of interest or a bid or an ask. We're taking data, and we're certainly taking very serious precautions with that data, in that it is all aggregated, it is anonymized. We're not here to try to reveal anything about any one market participant. This is more to help give people directionally what is happening in the marketplace. And that's where, some of these different products we've created out of those different environments I just spoke about, and each one of them vary a little bit in terms of what they do at either an asset class level or geographic coverage level. We'll talk a little bit more about that in a few more questions. But that's sort of the base case of just DTCC as a data provider.
Right.
So
yeah,
getting back to your original question, right? Because you want to hear that answer. Right. So now that we're thinking about this, so what is it that we're able to do and help people better understand markets, right? So because our data is actual trades and such a vast array of data, right? If we think about, say, equity kinetics, which is one of our services, right? So what's different about that is its completeness in terms of a source of U.S. equity activity each day, the way we're able to package that data in such a way that is very easy for the user to consume. We know users have tried to consume the same underlying data through other sources for as long as there have been financial markets, but they often have to go to a lot of different sources to really bring it all together. So those first two pieces are somewhat simplistic, but they do make the user's life a lot easier in terms of understanding just what is actually happening in U.S. equity markets. How does that differ over time? And then the other thing they're able to do is, because of the way we're able to break up the data in terms of different trade sides of the volume, they are then able to look at this from a sentiment perspective, and in a relatively easy way. Think about things in terms of buys versus sells versus shorts, and gives them a very interesting indicator of sentiment. And we know a lot of users derive a lot of that from our service. I always use the analogy of we're somewhat a supplier of, say, flour and sugar to a baker, right? Bakers go and make cakes, right? And our users are kind of like that, right? We're the ones giving them a lot of the raw ingredients they're going to use in how they're going to make that. They're the ones who are going to say, well, how much sugar, how much flour, how much of everything else, or how little, and say, okay, well, what does these different metrics I'm being given by do, and how do I turn that into something like market sentiment, or which segment of the market is doing the buying or selling of something, or which firms are raising or not raising as much short-term debt, and are they paying more or less for that? And those are the kinds of inputs we're able to give people who, have pretty sophisticated math science type of backgrounds, and or maybe engineering, and they're able to take that data and really harness it and turn it into things like those different sentiment scenarios, somewhat like that first example I talked a little bit about with the travel stocks in the pandemic and the financials in 2008.
Got it. Excellent. Well, those are excellent examples of how to look at the data and actually derive sentiment from it, which is an interesting angle relative to what other people are doing. So I see that as being very valuable. So let's and thank you for that overview. That was perfect. I think that timing for providing that background was vital, and we can move on from there more solidly. This next question is interesting. Opinions are split on the economic cycle post January. Given the uncertainty of the scenario, how does that post-trade data help investors think about near-term valuation and liquidity trends? And how does that help them trade effectively when markets shift higher or lower? You kind of touched on that, but maybe you want to expand a little bit more.
Yeah, so the way the users look at our data and are able to do that is, because we have such deep and rich histories of this data. So we talked earlier, I think, about how Investor Kinetics goes back to 2007. Equity Kinetics data starts in 2011. The money market data starts in around 2014. That really allows them to look at trends over time, over some different economic cycles. We now in Investor Kinetics are on our third president, it appears to be, since the data was captured. So actually four. Sorry, forgot that we have 2007. So we had a year and a half of the prior president, Obama. So that deep history, when you think about trends and liquidity, is really a very interesting set of information. When you can look at the universe of stocks you're either trading and or evaluating, right? Because that varies a lot from one investor to another. They've got all kinds of different parameters of their own that they're going to apply to that. But given the wide coverage I talked about earlier, given this deep history and how we've got this in a very consolidated and consistent format over time, users are then able to really test this out in a lot of different ways that make things much more clear to them than they had before. And we certainly understand that we're one piece of a bigger puzzle, right? They're not going to decide things based on our service alone, and we know that. And I think that speaks to sort of our data, but it also talks about how the toolkit that a user has these days has changed quite a bit and become much more advanced, and allows them to look at a very big jigsaw puzzle that we're a few pieces of, but along with a lot of other pieces, to really come to their conclusions about things like valuation and liquidity and where certain investment opportunities might be going.
Right, exactly. So, I mean, this next question, you basically touched quite a bit on that with the 2008 crisis, the snapshot. How, is this information enough to inform investors of, what is that trading activity which reflects on what is going to be foreseen in the future? You have this, you talked about the deeper history. Do you see anything else in the histories that are you showing things that others might miss?
Um, I guess we talked over this question just a little bit before, but the one thing I'll say is our users always tell us, the more data, the better. Because these are very, academic type of minds that are sophisticated in math, the more data they've got, the more scenarios they can test out. And I think that's, a little bit what we were talking about earlier, but, just to this question, that if they're able to simulate more and more scenarios, it gives them greater confidence in the outcomes of the data and what conclusions they can make from it.
I got it. So what you're saying is with your data, it provides an even more complete picture that they might not have had, which gives more
Correct.
accuracy and potential alpha generation. It's interesting because if you take a look at what's been going on in data in the last 3 years, it's just been absolutely a spectacular growth in data purchases. That seems to be the new paradigm shift, more not so much developing sophisticated algos, but developing algos against data, new data sets that were not available before, where instead of waiting for the end of the month or the quarter, you're getting alternative data sets in between, you're getting all kinds of valuable information on a real-time basis. And I know you provide data T+3 in some instances and less. But over the last couple of years, there's been a tremendous set of purchases. Do you feel that you're seeing more of your clients engaging in data analysis, analyzing the data that they've been sort of loading up on over the last 3 years? And do you expect this to continue not only in 2020, as we indicated on this question, but also into 2021?
I think we do, and I think what's driving that is, I think I was getting into this a little in the last question, but fortunately I didn't talk too far over it this time. But I think the technology changes we've seen in terms of cloud capabilities, in terms of other database tools that allow people to harness data is what's driving a lot of this. I think there were plenty of quants out there, 5 years ago or more, or even less, maybe like 3 years ago or more, where the toolkits that they have today are substantially better designed to harness all of these enormous data sets, whether it's one of ours or one of the many others that are out there, and really allow them to connect pieces and get to conclusions that they may never have been able to do in the past. This is probably some smaller degree computing power, but computing power hasn't changed that much in the last 8 to 3 years. But what has happened, certainly of late, is they've got a lot more tools to make it, and by the way, cheaper too, right? It no longer seems to be who is the largest investment firm or the largest AUM that is harnessing this, because these tools have not only become more sophisticated, their price points have become much more, reasonable for even a smaller asset manager or hedge fund who is able to put these things in place and connect a lot of these data sources and reach a lot of these conclusions. I always call it the democratization of the data technology. And I feel like that's what's driving people to look at more and more data sets, always be open to testing out more data sets, before and do all that analysis you were talking about, and then be able to put that into their investment process.
With the democratization, as you say, of this industry, I guess that would enable a lot more businesses to start up and get very sophisticated very rapidly, providing more opportunities, obviously, for DTCC. In my next question, we talk a little bit about, obviously, some of those tools that you talked about, like TensorFlow or what have you, machine learning applications, artificial intelligence. That is sort of the name, the popular, terminology of today. On your end, are you looking at enabling any of those tools to facilitate finding solutions or finding different sources of potential alpha within your data, or are you just basically providing? I think you mentioned earlier you're sort of providing the baker who has the
Yeah.
machine learning and AI.
So yes, this goes back to being sort of who's providing the ingredients and who's baking the cake. The data we provide today certainly has some mathematics involved in terms of aggregation and some other calculations because we're not able to show things at a single trade level, obviously, and it's actually considerably higher because we have to protect the anonymity of all the sources of our data. So we're doing some what I call rather basic math in terms of aggregations, averages, volume weighted averages, calculations like that, but that's not machine learning and AI. We certainly know that our end users will then, those bakers will then apply technologies like this when they ingest our data and when they couple it with other data sources. And, I think you were touching on a little bit about this democratization. The thing that really has surprised me in 2020, and I think you just alluded to this as well, is that it's not just those super large, well-resourced, in some cases, well-known hedge funds, but we've seen a lot of smaller shops that have a lot smaller AUM that, in some cases have 20 or less people working there. And they've found value in this data because they're able to take our data set and it's, in its aggregated anonymized form, relatively simple, flat CSV files, very consistent format, very good documentation explaining those formats, and quickly ingest it because of the different tools they've got on their side and because they're able to apply things like machine learning and AI to then harness the data.
Mm-hmm. Absolutely. You mentioned investor kinetics. Do you want to round that out a little bit? What sort of value does it bring? And is there similar data out there? Tell us a little bit more about investor kinetics. I guess that's really one of your lead with products here that we're talking about.
Well, I think we talked about the alternatives, which, the 13Fs have been around a while. But so what is it that people are actually doing, right? So every day we're sending out, it's T+3 embargo, but we're sending out data showing people, volumes of what has been bought, what has been sold, and then breaking it down into those different categories I talked about. We also create two other categories that show you things from a little bit more of a quantitative perspective. So there's a tier 1 of the 10 most active by volume, and that's just straight math. We don't look at any characteristics there. And then there's something called tier 2, which is the 20 most active by volume, and that's also purely a math decision. We're not categorizing anybody there. So what's really interesting there is, unlike other products where you're kind of looking at the totality of volume here, where buys are always equal to sells, right? Ours is a subset of that universe, right? So all of those, the total amounts we talked about, the 3 different categories we've created, the 2 more quantitative categories we've created, each one of them, is never going to equal each other, right? So you're always going to see some sort of delta between buying and selling in this subset, even though the wider market, obviously, there's a buyer for every seller, right? But and that's really where I think people see the value in this data set, because you're now able to say, okay, we can isolate a very sophisticated group of investors as in aggregate, and we can see from the plus or minus scale how they are all working out. Are they really accumulating something? Are they really getting out of something? Are they just sort of holding what they have? And that's really the core of investor kinetics and what it does, right? There's a lot of different math points in there. There's a lot of sophisticated mathematicians that are our clients who are doing all sorts of, far more creative and advanced techniques than I can explain. But we know at the core that is where the value is, in sense of seeing, which side of the scale is going up or down in that very specific group.
Gotcha. So you could back test what the institution, a specific type of buyers are buying and see how the market reacts to that. And maybe you want to take a a different view depending on what the sophisticated buyer would buy. But having all that data available will allow you to set up different strategies against or with specific type of institutional smart buyers.
Yep.
Um, all very, very interesting. We you've got so much as an offering right now. I'm sure that you're talking to clients on a daily basis about what additional products they might be interested in. Have you thought about what else you have? Do you have anything on the shelf that you're analyzing or going to provide to the marketplace that might be useful, that your clients are telling you is useful?
So the short answer is yes. The amazing thing about DTCC is, we've made some interesting products, but there really is an incredible wealth of data that we have done either nothing or very little with yet. Some of the things we're looking at to bring out next year is something called Treasury Kinetics, where we're going to look at repo markets with Treasury-related products and create summaries of repo activity each day. Somewhat analogous to what we've done in the other areas, but looking at a very different asset class and different kind of activity, where the market is definitely telling us they're in need of better data, lack a lot of transparency, and would like to understand more about repo activity at a single security level. We haven't talked a lot about our money market kinetics service. I know I alluded to that at the beginning. That is a service that helps people understand commercial paper, institutional CDs, so very short-term debt, and we're showing settlement data on those different securities each day. Actually, that's one we're able to deliver intraday. That was originally created for a lot of the bond traders, either on the sell side or the buy side, who deal in those kinds of instruments, to really just help them better understand that market. One thing we've noticed in the last year, and we're doing, and this gets into what we're going to do next, is a lot of our equity users have started to recognize that the issuers you see in this money market kinetics service actually are the same issuers of underlying equities they trade. And they're starting to see a relationship between how much debt these companies are raising in the short-term markets, what kind of rates are they paying to borrow, and how does that differ from their peers? Virtually all of the companies in there are large, global, large corporate blue chip type of names. And one of the things we're going to do to help them with that is we're creating a mapping in the money market kinetics service that will allow them to easily jump from that money market issuer to the underlying equity instrument. Sounds somewhat simplistic, but that's actually one of the biggest pieces of feedback we've got is just connecting different reference data points of different issuers is really an incredible time saver in some of the analysis these users will do with a product.
Yeah.
And then along the lines of equity kinetics and investor kinetics, those have now been in the market for, investor kinetics is actually less than a year still. Equity kinetics is a little over 2 years, but we are looking at some new aggregations, things like 5-day rolling aggregates for each one, which will make some more data available. I think I said earlier, more data is better, and that's the one thing every client seems to always tell us. And then we're also looking at some alternate delivery schedules that might accelerate when we are able to give out some of this data. We already made one technological advancement with equity kinetics this year, so we've upgraded the infrastructure so it does actually get published a couple hours earlier each morning. So maybe it was coming out at around 5 a.m. It's probably coming out closer to 3 a.m. These days. But we're also looking at things like intraday summaries for equity kinetics, and we're also considering what options we have in terms of investor kinetics and moving from, say, T+3 to something sooner.
Wow. Well, you guys are busy. I think there's a lot that's coming down the pike, as well as extremely valuable information that you're offering today. And I want to thank you, Matt. In summary, we review various data offerings, the investor kinetics, equity kinetics, et cetera, that quants can access to provide additional components to their overall data analysis to generate additional alpha. Matt, you provided several use cases. I thought that were very, very explanatory, showing how the data can be used and future offerings as well that might be useful, primarily from a lot of customer requests. Matt, that was a great overview, and thank you. our listeners, we hope you enjoyed today's session. Thank you for listening and have a great day.